Hello and good evening. We are going to start with chapter number 2 of your AFM syllabus, which relates to investment appraisal. That means this is a chapter which will teach you something how companies decide if they have to invest in a particular project or not. Are there any methods available to see how to evaluate this, how to assess this? Yes. So in this chapter, we are going to study some of the methods which you have already studied in your FM paper. It includes NPV, it includes payback period, it includes IRR. These are some of the methods by which a company or even we will learn to decide if a particular project must be taken or not. It must be chosen or not. That is why this chapter becomes the basic pillar of your AFM also. Investment appraisal, how businesses actually decide which project is going to be profitable for them. Everything is going to be there in this chapter. So let's just first begin with understanding the overall chapter contents. This chapter contains more practical calculations here, less theory. So we have to be very cautious while dealing with these methods. You will learn calculating NPV, net present value of any project in this chapter. Then you will learn how to calculate the IRR, internal rate of return. Then MIRR, modified internal rate of return, which is an upgradation of IRR. Then you will learn what is the concept of payback period. Payback period, it was there in FM also. Here we are going to see a bit next step to it. Then we are going to learn something new. That new is duration. This is a new concept which was not there in FM. And here we are going to see this. And at the end, you will learn about capital rationing. So capital rationing is also a practical problem which is faced by a number of companies because the companies do not have unlimited capital. So they have to opt for some capital rationing while deciding which project to take up, which projects not to be taken up. So this is how the whole chapter will go. Let's just begin with understanding first the basic thing which underlie a company. So a company has majorly three decisions which are linked to each other. Now, what are these three decisions which are linked to each other and which you have to remember and quote every time when you are writing an answer? The question will ask you the impact of one particular decision on different areas of the business. This is the slide which is going to cover up that portion. First thing, investment, which project to choose. So to decide this, we are going to use NPV, IRR, payback period and blah, blah, blah. This is the step where we are going to apply the methods. Where and which project to choose, where the investment must be made. Next question, which comes after the decision is done for an investment. Finance. How will this investment be funded? How will you fund this project? If it is to be complete debt, if it is to be equity plus debt, if it is to be complete equity, how to finance it? That's the second decision which a business has to take. And the third, dividends. Now, this is something which talks about shareholder wealth. Now, remember one thing, shareholder wealth doesn't go only by the dividend payouts. Shareholder wealth is increased in terms of capital appreciation in the value of their shares also. That means if the market price of the share moves up, that also leads to creation of shareholder wealth. So here we will only talk about dividends, how much the company wants to pay or the company should pay, and how much should it retain. Because these retained earnings are going to be a source of finance for any other project to take up in the future. Or maybe the same project, maybe that project requires funding in the near future again. That will come from these retained earnings. So these are three major decisions which are linked with each other and on which you are going to study a lot of content in AFM. One, which project to choose. Two, how should this project be funded, or how should the finance for the project be arranged. And third, dividend decision. How much dividend must be paid, and how much amount of profits must be retained. These are three different decisions, three key decisions, which companies struggle to get an answer on. Remember, you have to quote these three when you're writing the answers in the exam. The examiner looks for these key decisions. Next comes investment appraisal. There are some concepts which we are going to see and study, which are there on your screen. Dealing with taxation, we are going to see. Dealing with inflation, because we are living in an era which is not inflation free. So inflation's impact you have to give in the cash flows. Then NPV calculation for capital rationing. That means where the capital is limited, you have to choose certain projects only. All projects cannot be taken up. So we will learn that also. And these are based on free cash flows, these concepts, but there are some economic return basis also. That means how much is the actual economic return when we talk about a project. So we use IRR and modified IRR here. We'll go into deep on these methods also. So let's just quickly first see the major item which we will see in a number of methods, which are going to be there in a number of terms, in a number of questions, in number of methods and questions, practical questions. What is this term? This term is free cash flow. Cash flow which is free to flow? No. So free cash flow, sir, there is a particular terminology, or there is a particular definition which is associated with free cash flow. What is that terminology? Cash which is free for distribution to the shareholders. Cash which is free for distribution to the shareholders. That means cash which is not retained in the business. That means cash which is not reinvested in the business or any project, which is free to be paid as dividend. That means out of this money, the company can pay dividend to the shareholders. Dividend pay kiya ja sakta hai. There is no restriction on it. That's free cash flow. So there is a small formula also devised here. One, all your revenue minus all your costs will give you the cash flow. Now, once you have taken out the money, which you think that this has to be invested, now the remaining is free for dividend payment, free for the purpose of distribution to shareholders. That's free cash flows. So this is the formula, just a simple one, nothing to worry on this. Now let's next come up to net present value, the most important concept. For net present value, we again need to get back to some basic terminologies. One, the concept of relevant cash flows. What is this relevant cash flow? So let's break this term relevant cash flow. One is relevant, another is cash flow. Cash flows we just saw. The only thing which you need to remember here, these cash flows relate to both costs as well as revenue. Cash flow doesn't restrict itself to only revenue. Cash flow is revenue as well as cost. Now let's come to the word relevant. What is the meaning of this word relevant? You must have seen this relevant when you were studying PM also, and in your skills level in FM also this terminology was used, but majorly in PM. So what is relevant? Let's understand this. When you are considering a particular project, if any revenue, any cost is going to be there just because of that project, then it is relevant. Why? Because this cost is going to come only if you accept that project. If something is already incurred, if a cost is already incurred, it is sunk cost. Even today, sitting here, if you decide that the project should be taken or should not be taken, the situation doesn't change. Sunk costs are already incurred. वो हो चुके हैं. आप आज चाहे डिसाइड करें कि ये प्रोजेक्ट लेना है या नहीं लेना है, it's irrelevant. Why? Because these costs are already been incurred. You cannot change the fact. If you accept the project, still paid. If you reject the project, it is still paid. That is why it is termed to be a sunk cost. And when we talk about relevant cash flows, relevant means something which is going to be incurred in the future, not in the past. That means the major terminology relevant brings one more point here, that the cash flows should be futuristic, which are going to arise if you accept the project. And last one, incremental, which are not your cost at the existing situation. They are incremental. They are going to happen only when you accept the project. That is incremental. And in total, these 3 points, these 3 words, they lead to the definition of relevant cash flows. Relevant cash flows include both costs and revenues, which are futuristic in nature, along with being incremental because of acceptance of the project. Right? So you have to be careful with this. Any overheads which are just apportioned to a particular project is not relevant at all. Any fixed cost, not relevant. Non-cash items, they may be relevant, but here we are talking about relevant cash flows. Cash flows. That means their nature has to be cash. Non-cash items won't find a place in relevant cash flows. That's the whole idea behind this. Then comes the concept of discounting. That means studying the simple discounting, how to calculate annuity, what about perpetuity, everything is discounting. Now to understand this concept, let me take you to a small screen where I'll brief you up how discounting process takes up. So let's just quickly run through that, right?
So let's just understand the concept of discounting, how it works. There are 2-3 major cases where you have to be cautious. Number one, you always start your question with year 0. I will always advise start with year 0. Then let's suppose the life of the project is 5 years. We mark it like this. 5. So year 0, you are going to mark up as investment. Remember, year 0 will be your point right now. That means this is the point right now. Year 1 is after 12 months. This is 0 point. That means now. So the only confusion which usually happens is students consider these two to be 2 different years. Remember, these are not 2 different years. They are simply the first day and the last day of the same year. Then again, next year 2 comes again after 12 months, then again after 12 months, then again after 12 months, and again after 12 months. The biggest thing which you have to understand is the present value concept will come into picture starting from year 1. Let's suppose the rate which I have to use for calculating the present value is 10%. Now 10% if I take at year 0, it will not change the present value of my money. At point 0, the present value factor, it is going to remain 1. Now how do you calculate the present value factor at year 1? 1 divided by 1 plus rate. So use your calculator, or you can just view the present value tables also. Present value table will be there in the examination. If you do not want to use it, just do calculate this by using your simple calculator. That is 1 divided by 1 plus rate. That gives you a value of 0.909. Press equal to again. You get 0.826. Again equal to 751. Again equal to 683. Again equal to 621. So these will be the factors. Now you will have some cash flows. Which will fall into all of these values. Now, how do you see those cash flows? So these cash flows will be at point 0, you will be making an investment. Let's suppose I make an investment of $50,000. Inflow is going to be 8,000. Then let's suppose 10,000. Then let's suppose 11,000. Then 12, and then let's suppose 9,000. So this is how the investment is going to be. Now, if there are different values every year, I will simply advise you calculate the present value like this into this, copy this formula and paste it everywhere. Now take the sum of it. This is the net present value of the project. And this is simple discounting. This is simple discounting, how you do the discounting. Now, every time the question may confuse you by taking different values. They may give you annuity factor also. What is that annuity factor? The same situation, what can happen is, if the values are same over years, that means I'm talking about the values 8,000 to remain same every year. This 8,000. Don't you think it's going to be a repetitive exercise that you multiply 8,000 by 0.909, then same 8,000 by 0.826, then same 8,000 by 751. So what can be done is you can use an annuity factor. What is this annuity factor? You can track down the sum of these factors, that is coming to be 3.79. And you can do this 8,000 into 3.79. 30320. So this gives you a value which will be equal to the total of all these. That's how you can use the annuity factors also. I mean, here it will not be equal because the values are not 8,000. But let's just check this if this is happening with this column. If this activity is done alag-alag, that means I'm just multiplying them separately. What is the sum of these values? Let me check that. See, 30320. So sometimes you will see the book also using this shortcut. Yeah, this is a shortcut which you will find here. And what annuity table is for? When the values are common, आप अलग-अलग multiply ना करके, you can take the total of the values, the present values, and you can multiply it once only by 8,000. So that will directly give you the sum. So this exercise is saved. Another thing, sometimes the cash flows are till perpetuity. When cash flows are till perpetuity. Now, what is this perpetuity? So the concept of perpetuity is, here we know that the cash inflows are going to be for 5 years. What if I tell you that you invest today and you get return for infinite period of years? That means there is no counting कि आपको ये return कब तक मिलेगा. You will get this return for forever, infinite number of years till the time you live. That means I don't know till what year I have to take the present value factor. Now what do? I will have to simply calculate the present value by using this formula. Whatever is the cash flow, divide by the rate. Simple. Now what is this rate? Let's suppose 8,000. Every year you are going to receive till infinity. So my present value would be 8,000 divided by 0.10. 80,000 is the present value of this investment. You invest some money, you will get 8,000 of cash inflows for n number of years from now. This is how you calculate the present value when it is a case of perpetuity. Now, sometimes what happens is, I assume that only 8,000 is going to be received every year. What if this rate, which is 10%, this 10% is the return. What if this also grows? That means the return is also growing. There I use present value equal to the increased cash flow divided by R minus G, rate minus growth. This is how you calculate it. That means if you are saying that 8,000 is going to grow at a rate till infinity, what is the return I am taking? I am taking 10% minus what is the growth rate? Growth rate, let's suppose 2% we are going to increase on annual basis. So this is what you use. That means you use 8,000 divided by 0.08. That's 8%. So 8,000 divided by 0.08. That will be the present value of such an investment which is growing in return also. When the returns are stagnant, you simply use whatever is the return or cash flows divided by R, your rate of return. But if your return is also growing, you take the cash flows, but you divide by R minus G. This is what you take. right? And then you will have to be cautious seeing this, that this 8,000 is after growth or without growth. That you will have to see on a case to case basis. So this, wherever we'll confront a situation, we will use this. Here also, what you have to be cautious on is, when are the inflows coming? So majorly the question confuses you, ये inflow कब आएगा? The question may come up saying कि ये जो inflow आएगा ये year 3 से आएगा. So you don't get confused, just put it from this place. So present value factor B, you have to apply 0.751, 0.683, 0.621. This is what you have to do. So just move them to आगे वाला years. 7, like this. The present value factors will also be taken for these years only. If cash inflows, that means returns you will start earning from year 3, not year 1 immediately. आप year 3 के आगे इस value को लिखो. Present value factors year 3, 4, 5, 6, 7 के ही use करो and then calculate the present value. So simply you will have to see this, which question is giving you what information. जो भी information है, based on that calculate the present value. I will advise, until unless it is too long in calculation, NUT में मत फंसो. NUT may confuse you at points कि कौन सा inflow किस year पे arise हो रहा है. We will see this concept in more detail when we'll start doing the exam kit questions also. Till the time, just do understand this simple concept, which is quite easy to absorb.
Saw that and understood that. So once you have been through this concept of discounting, next comes for you is the impact of inflation. So for understanding the impact of inflation, first understand the overall concept. What is inflation? Inflation is महंगाई, when things become costly. Now a normal investor, what will he do? He's giving you money to invest in a project. He will expect two types of returns here. First return he will expect is the normal return, which he will invest anywhere and he will get back. The normal return. But in case of inflation, he will try to have the impact of inflation also in his earnings. He will obviously not expect, okay, let's take a small example. You go to take a house on rent. Why every year the house rent increases by 10% or 5%, whatever your owner has agreed upon? Because of inflation. There are troublesome situations where the houses have been taken on rent since last 50 years and they are on the same range of rent. That means 1 rupee, 2 rupees monthly. These are disputed properties. But normally this situation doesn't work. You will see a clause of 10% hike in the rent every year. That means the investor, that means the owner of the property will also expect some proportion of inflation also in his earnings to be reflected. That is the whole idea why here two concepts are being talked about. These two concepts are real rate of return and nominal rate of return. That means here, because of inflation, the overall required rate of return of the investor, it is the nominal rate of return, which you term as money rate of return. So there is a Fisher formula to understand this concept in more detail. One, there is normal real rate of return. Real rate of return is the base rate of return which he expects because he is lending you money. He is investing his money in a particular project. That is the normal expectation. But to give effect of inflation in the rate of return, there comes into picture nominal rate of return. So in layman terms, you can say real rate of return doesn't include the impact of inflation. But money rate of return or nominal rate of return considers the impact of inflation. Now, how do we calculate that? So there is a simple formula here. 1 plus I is the money interest rate, या nominal rate of return or nominal interest rate. This should be more than the real rate, right? So how do we calculate that? So 1 plus I is equal to 1 plus R. R is the real rate. Now inflate it. By what rate? Rate of inflation. So multiply it by 1 plus H. H is your inflation rate, general inflation rate. That means here, if the real rate is, let's suppose, 8% and inflation is 10%, so you take up 1 plus 0.08. 8% is 0.08. Bracket close. Then 1 plus H is 10%, 0.10. That will be your 1 plus I. That means your money rate of return or money interest rate, nominal interest rate. That in any case is going to be more than the real rate of return, right? So after this, the question in your mind must be, why are we studying this? To give the impact of inflation in cash flows. That's why we are trying to understand the concept of real rate of return and nominal rate of return or money rate of return. So here on the screen, you can see there are two types of inflations which you have to consider or you will face in the exam. One is specific inflation rates. Another is general inflation rates or general rate of inflation. So what is specific inflation rate and what is general inflation rate? That's a simple thing which is evident from its name also. Specific inflation rate, which impacts different items at different rates. In India, you can see petrol rising at a different inflation rate. Then consumables rising at a different rate. The inflation rate is not consistent with each and everything you buy. But general rate of inflation is common, that on an average, this is the inflation rate which is prevalent in the nation, in a country. That is general inflation rate. Now let's just understand them in deeper. Specific inflation rates impact all the individual cash flow items. Each cash flow is affected by a specific rate. That means material will increase with a different rate. Labor will increase with a different inflation rate. Rentals, that means fixed overheads, will increase with a different rate. That is specific inflation rate. But when it is general rate of inflation, that impacts the investor's overall required rate of return. So with general rate of inflation, the investor will be interested in earning something more based on one general rate of inflation. Just one rate applicable to overall rate of return. But specific rates applicable to individual items of cash flows. That's the difference. Next, when it is general rate of inflation, investors in the project need compensation for their lost purchasing power, which relates to their ability to buy a basket of all goods rather than any specific one. So what happens is, when it is a case of general rate of inflation, the investor will look for a general loss of purchasing power. That is what he will look for. General loss of purchasing power. Because महंगाई है, महंगाई में क्या होता है, I'll tell you this. Let's suppose in Indian INR, Indian rupee, आज हम जो आइटम 1 रुपए का खरीद सकते हैं, वो 1 साल बाद में 1 रुपए में नहीं आएगा. That's the impact of inflation. That is the loss of purchasing power. Something which you can buy today at 1 rupee, you won't be in a position to buy the same item for 1 rupee after 1 year's time, if there is inflation prevalent in the country. The worth of your 1 rupee will go down. Now, if it is a 10% inflation, then the worth of your 1 rupee is going to be 90 paisa. This is how we calculate it. Simply reduce it by 10%. The worth, the earning capacity of the money goes down. So when it was earning an item equivalent to 1 rupee, after 1 year, it will buy only 90 paisa worth. It will carry 90 paise ki worth. This is what you can say when it is general inflation. And there is always a loss of purchasing power when we talk about inflation happening in any country. So yes, inflation is going to be there with us for a longer period of time, longer portion. But here, let's come to methods of dealing with inflation. Now, how do we deal with inflation? We have two different methods here. One is a real method, another is not an artificial method, it's a money method. It's known as money method. So when we use the real rate of return, that's real method. When we are using nominal rate of return, then it is nominal method. This is the simple layman language which I am saying. Now let's dig deeper into more technicals here. Real method. Do not inflate the cash flows. Leave them in real terms. Discount using the real rate. And there you are ready to use these numbers for calculating NPV. That means first, don't inflate them. Now, when you have not inflated them, don't use an inflated rate of return to discount it. Fair enough. That means the opposite will happen in case of money method. Yes. First, you inflate them with specific inflation rates, and then you use money rate to discount them. So that's a simple concept. If inflated cash flows are being used, then the rate of return to discount those cash flows must also be inflated one. And that's the money rate. But if the cash flows are not inflated, please do not use a discounting rate which in itself doesn't have the component of inflation. That means you have to use real rate here, right? So that's the consistency we have to maintain, we have to ensure. Now, there is a note which I have given here on the screen which you can see. When all cash flows are inflating and at the general rate of inflation, use real method. When cash flows move at specific rates of inflation, use money method. So this is in terms of your exam approach. When in the question you have a general rate of inflation, you can use real method. That's up to you. Don't inflate the cash flows. Don't inflate the rate also. But when there are specific inflation rates, you will have to inflate the cash flows. In any case, you will have to inflate it. And then you will have to use the money rate to discount it. That means you have to use the money method. So remember this point. Whenever there are specific rates of inflation, you have to by default use money method. But if specific rates of inflation are not there, general rate of inflation is there, you can use real method. That's what is this note trying to say, right? So let's move ahead to a practical question. बनता है यहाँ पे, because we need to see how these concepts are applied practically also. So I'll quickly disappear and a screen will come where you will see a practice for these concepts, right? Let me just move away from your screen. So this is Test Your Understanding, one of your study text, which is for NPV with inflation revision. A company plans to invest $7 million in a new product. Net contribution over the next 5 years is expected to be 4.2 million per year in real terms. So underline this real terms. In real terms means without inflation. Marketing expenditure of $1.4 million per year will also be needed. Expenditure of $1.3 million per year will be required to replace existing assets which will now be used on the project but are getting to the end of their useful lives. This expenditure will be incurred at the start of each year. So till here we need to understand the question first. Number one, the company is planning to invest $7 million in any new project. That is introduction of a new product. Net contribution for the next 5 years are going to be $4.2 million per year. That is in real terms. That means this amount has not been inflated. So that is point number 2. Third, marketing expenditure of 1.4 million per year will also be needed. So this 1.4 of marketing expenditure is also going to be needed every year. Expenditure of 1.3 million per year will be required to replace existing assets. That means here you are going to incur a capital expenditure. This is not a revenue expenditure. So this is 1.3 million per year to replace existing assets. Underline this word replace. That means you are going to create, fleet of new assets, which will now be used on the project but are getting to the end of their useful lives. So we will have to incur these amounts to for the assets to be in the working situation for the project. This expenditure will be incurred at the start of each year. So that means at the beginning of each year, you need to incur this expenditure of $1.3 million. Additional investment in working capital equivalent to 10% of contribution will need to be in place at the start of each year. That means working capital investment is also required. So till here I have seen three investments. One, the initial investment of this $7 million. Second, I have seen this investment of $1.3 million for assets. And three, now I am seeing the working capital investment of 10% of contribution. Right? So whatever is the contribution, 10% of it, it is going to be the working capital investment at the start of each year. Working capital will be released at the end of the project. Understand the meaning of this sentence. Working capital will be released. What happens is when you invest working capital, every year it keeps on coming back. Then you reinvest some amount. How? For example, you have to do some production now. So for that production, you need some money. That is your working capital requirement. Now production has happened. Now you will sell out this production to someone by creating receivables. Now these receivables will pay you back. Some amount will come back in terms of the cash sales. That means whatever working capital you invest, it comes back in cash, either in form of revenue or coming back from the receivables. So this is what they have said, that at the end of the project, it is going to completely released back. That means whatever you have invested, that is going to come back at the end of the project. The following forecasts are made of the rate of inflation each year for the next 5 years. Contribution is going to get an inflation of 8%, marketing 3%, assets 4%, general price level is 4.7%. The real cost of capital of the company is 6%. That means the real cost of capital is given to you. You need to calculate the money rate here. When you are using specific rates of inflation, you need to inflate each and every item separately, and then you need to apply the specific rate of inflation to it. Sorry, the money rate to discount it, right? The real cost of capital is 6%. Cash flows are in real terms. They have clearly mentioned that all the cash flows are in real terms. You have to convert them to money return, or applying the money rate of return, you have to convert them to nominal terms, money terms. Required. Forecast the free cash flows of the project and determine whether it is worthwhile using the NPV method. That means, is this project worthwhile? That you have to tell them. Okay, so we start doing this question on the Excel. You can also do this in the Excel. You are not going to get any paper, pen, anything in the exam. Now, how do we follow the approach of these questions is simply, I will suggest you start your year with year 0. I'll always suggest that this. Start with year 0. Why? Year 0 is now, exactly, abhi, right at this moment. After 1 year from this point, the first inflation will apply. First return will also come. So if I take this point 0, let's suppose this point 0 is 1st January. That means 31st December, you are going to receive your first contribution. You are going to incur your expenses. But initial investment will happen today. This investment in asset which they were mentioning here, they were saying that it is going to be incurred at the start of each year. That means this is going to be incurred right now. Abhi ke abhi. Likewise, what about capital, working capital? Working capital is also to be put in place at the start of each year. That means this is also going to be incurred right now. That is why we will start it at point 0, year 0. Then we will take year 1, year 2, year 3. Now, how do we write that? Just see this. Year 0. So this is the point right now. We are at year 0. Then we go ahead to year 1, year 2, year 3, year 4, and year 5. Don't get confused in the years. I'll start explaining them. I'll explain in English as well as Hindi so that you understand this concept very well. Right? So now, what was the situation? The situation was first talking about your contribution. The first information came out was net contribution. When is the contribution going to come? Only when you start selling the product. Time zero is what? Or year zero is what? Right now. अभी के अभी तो कुछ नहीं बेच देंगे ना. First we need to produce, then we can only sell. Right now you cannot sell. So you will take पूरा 12 months or पूरा year, the whole year you will take to produce and sell. And then at the year end, then you will receive the first contribution. That is how it goes, right? So this year zero or time zero, year zero, this is right now, year one happens after 12 months, you can say. So this is the first 12 months wala period, year one or time one, after 12 months, after 1 year. So now you receive a contribution, right? You can mark it as time one also. So contribution will not come at point zero or time zero. It will come at year one. Now how much will come? That how much is 4.2 million, but that is in real terms. Let me write 4.2 million. Another thing, always carry the question, try to carry in triple zeros. That's always recommended. So we will take all these amounts into dollars, triple zeros, right? So 4.2 million is how much? 4.2 million into 10 lakhs. This comes to 442 lakhs. Okay, but I need in triple zeros. So let me remove 3 zeros out of it. So that's 4,200. But this 4,200 is in real terms. Don't you think we are here at right now? After 12 months, the inflation will impact our cash flows? Yes, it will. Now, how much is the inflation for contribution? It is 8%. That means my contribution is going to be more than 4,200. It will have an impact of inflation. Inflation की वजह से वो ज़्यादा amount हमारे पास आएगा. We will receive more. How much we will receive? That you have to do in Excel by multiplying it by 1 plus rate. So your rate is 8. So I do it 1.08. Multiply it by 1 plus rate, 1.08. You get 4536. Right? So every year you are going to receive the same amount of contribution, and every year the contribution is going to inflate at 8%. So now I have one number here that this will increase again by 8%. Right? Now again, this previous year figures will increase by 8%. Again, by 8%. Now, if you get confused in year 5 or year 4, where should we end it? So remember one thing, you have to receive 5 contributions, right? The project's life is 5 years. That means 5 times you will receive the contribution. If you start receiving at point 1 or year 1, then you have to take to year 2, 3, 4 and then 5. Till year 5, you will receive this contribution. Got that? So that's the first part which you have done. Now let's come to the second portion. That second portion is the marketing expenditure. Per year you are going to make this expenditure. When are you going to make that? Let's assume this is the normal expenditure. You are not going to make a marketing expenditure before the production is ready. That means you will not incur this expenditure right now. You will incur this expenditure after 12 months. That means point 1 or year 1, year 2, year 3. So less marketing expense. Not here, you will incur here. Now how much is marketing expenditure? 1.4 million. So 1.4 million into 1000 I'll do. I get 1400, but again it was in real terms. Now from now to 12 months, inflation has been in place. Marketing is getting inflated at 3%. Now I need to inflate this amount by 3%. So 1.03 I multiply it. Likewise, This is how you calculate the marketing expense also, right? Now, after that, what is the expenditure? Now, this is a capital nature of expenditure. That means all routine and operating expenses are done. Now, what do we need to do? We need to simply calculate the operating cash flows. Just copy this, apply it to all the years. These are the operating cash flows, right? Now, next, once these operating cash flows are there with us, now we need to see how much investment we have made. So first is the initial investment. How much was the initial investment? The initial investment was for $7 million, right? Take it in minus. 7 million is 7,000. 7,000 rather, right? Next, there was another investment. We had talked about 3 investments. Second investment is this 1.3 million per year to replace the existing assets. This expenditure will be incurred at the start of each year. Now remember, at the start of each year, that means for first 24 months or first 12 months, production tabhi hoga when your assets are going to be usable. So you need to incur this expense right now. अभी के अभी ये इनकर करेंगे, तब जाके assets ready होंगे और पहले साल के लिए production करने लायक होंगे. That means you have to incur this amount right now. That is 1.3 million. 1.3 million on asset, what should I say, replacement. 1.3 million right now. So right now you won't have the impact of inflation, but when it is incurred after 12 months, it will have that impact. So now when should I take it? After 12 months, but not at year end. It will be at the beginning of year 2. So year 1 ka end or year 2 ka beginning are one and the same thing, right? So we take this here at 1300 into, let's inflate it. What is the rate of inflation here? It is 1.04. 4% is the rate. Remember, I'll repeat this. You are making this expenditure at the beginning of each year. So beginning of each year is right now. We start here. Right now is beginning. Now the next payment will be done after 12 months. What is the point after 12 months wala? You will say year 2 ka beginning. But here we are taking year 2 ka end. That means year 2 ka beginning will be here. Year 1 ka end will be second lot ka beginning. So be cautious with that, right? Then next comes again this into 1.04. Now remember, you have to take it only for 5 years, 5 times that you have already taken. Oh, I mistakenly took 5. Let me take at 4. Right? You have to take only 5 installments. Only 5 we have taken. So 5 asset and replacement amounts have been invested. Now let's talk about working capital. What was the working capital amount which you need to invest every year? 10% of contribution. That means here 10% of contribution has to be invested at the beginning of each year. And at the end of the project, it will get released. Now working capital, be very careful. In the first year, you will have to invest the whole working capital. That means 0.0. You will have to invest the whole amount of working capital required. How much is that? 10% of contribution. So because it is an investment, I'm writing in minus, but I'll take, this is the contribution which I am expecting or going to run into 10%. This is what capital, working capital you need, right? Now remember, for the next years, now how are you going to deal with the working capital? Be very careful with that. Every year, you do not invest the whole amount. You just invest the additional. Why? Because some amount will be released from this year's sale also. You are not supposed to have every time 10% of contribution to be reinvested. This is what is to be maintained. 10% of contribution is required to be invested as working capital. That means that much working capital should be in place. How do you calculate that? For the first year, I do not have a balance in the box of working capital. Assume that to be a box. Let it be a dabba. You have accumulated 454 there. Now next year, after 1 year, this 454 will get released. Your receivables will pay you back. The amount which is blocked in inventory will come back in the form of revenue. So this will come back. That means now your box of working capital has how much amount? 454. After 12 months, I'm saying, when you have made some sales also. Now this is there. That means plus 454. It has come back to me. But again, the question said 10% of contribution should be there in the box. That means this much is the contribution. 10% of it should be invested. I need 490 now. Let me put it as minus. So 490 is required. We already have 454. How much investment in working capital should I do? Take net of these. That means we need to invest 36 to maintain a balance of 490 in the working capital box. Right? Likewise, now you have 490 balance in the working capital box. This will come back again after 12 months. This 490 will come back. Now you have a balance of 490 in the box. How much do you need? You need 529. Again, let me take it into minus. I have already 490 in the box. 529 is what I need. How much should I put in the working capital investment now? 39. Got it? So this is how we calculate for working capital specially. But only for working capital this happens. Now again this 529 will come back to you through some sales, through some receivables. Now for the next contribution into 10%, this is the requirement. I need 571 in the working capital box, but I have only 529. How much do I need to invest? I need to invest 42 only. Right? Now here 571 will come back. We need 10% of contribution, that is 617. 571 is there. 617 is required. How much additional amount do we need to invest in working capital? That is 46. Now, how much is the balance you have accumulated in the working capital box? That is 617. That means at the end of the period, you will get back 617. That is termed as release of working capital. So did you notice, do you remember in the question, we just saw this line, working capital will be released at the end of the project. This is this point. Whatever is the working capital you have accumulated, that is going to come back at the end of the project. Right? So this is how it is going to come back. So year 5, you will get back. You have to make investments only how many times? 5 times. 1, 2, 3, 4, 5. The cells which I have highlighted. 5 times you have invested in working capital, and then at the end of the project, it will come back to you. Got it? This is how you calculate it. But now these calculations are not relevant for me. So I need to erase them. Okay? Or let me just put them as a separate working. And I will just take the net values here. Okay. Right? So this is the working capital impact. Now we have everything. We have all cash flows, which we term as free cash flows. So we have free cash flows with us. Right? These are the free cash flows. Now, what was the question's requirement? Let's get back to that. They wanted us to calculate the free cash flows of the project to determine the net present value method के लिए calculations, to determine the cash flows for NPV calculation that we have done. Cash flows are here. And now they are saying determine whether it is worthwhile. That means now we need to tell them also after calculating NPV if it is worthwhile to take up this project or not. Right? Now how do we do that? Real cost of capital is given to you as 6%. But I have inflated the cash flows. That means wherever the specific rates of inflation are used to inflate cash flows, you need to use the money method. That means I need the money rate of return to calculate the NPV, right? How do I calculate the money rate of return? You remember the Fisher's formula? That formula will be applied here. What was that formula? It was 1 plus I equal to 1 plus real rate of return into 1 plus rate of inflation. So I was money rate, right? So I will take 1 plus I simply here, just like that. But now I have R. What is R? R is 6%. So I should take 0.06. Do I have H? But there were multiple H's. That means there were multiple rates of inflation. Which rate should I take? Now take general price, because we cannot take assets ki, marketing ki, or contribution ki inflation rate here. We need a common rate. That common rate comes out to 4.7. So we will take 4.7 here. 1 plus 4.7. Right? This is how you put 4.7. And now when you solve this, you get a rate, money rate of 11%. Right? You solve it, please. Money rate of return, or I, that's 11%, right? Ideally it will be 0.11, 0.11. So 0.11 is 11%. Now where will we use this 11%? To discount the free cash flows. So we can use the present value factor for 11% here and then calculate it. So at 0.0, this factor is 1. It will have an impact only after 12 months or 1 year. Now if I calculate this present value factor on the calculator, how do we calculate that? 1 divided by 1 plus rate. So 1 divided by 1.11. The first factor comes as is 0.9009. Although it is 0.9009, we take it as 0.901. Then press only equal to. It is 0.8116, but we will take 812. Again press equal to. 0.73119. We will take only 0.731. Again press equal to. We take 0.659 because it is 0.6587. We can take 0.659. And again equal to, we take 0.593. To take till 3 decimal places. Oh, 593. Okay. Now how do we calculate the present value? See, the way I'm doing it, you have to do this in the same pattern in the exam. Present value of free cash flows. This into this, copy this, paste everywhere. Right? Now let's just calculate the net present value. Again, here we will apply a formula. Net present value comes out at 789,000. 789,000, which is positive. So how do we decide when we are using this NPV method? Positive NPV of any project, that means the project is profitable. This is how we decide, right? Is it better with bold? Yes, much better. I've taken it pehle. Right? So NPV 789, that is positive. That means the project is worth accepting. It must be accepted. This is how you do this impact of inflation in these questions. Okay? Done? Understood? Practice these questions again. Now coming ahead with what we have to do now is the net present value, specifically giving an impact of taxation. That means here we will have to see how taxation has to be dealt with when we are using NPV method of investment appraisal. So tax, you have to consider two different treatments here which relate to two different items. One is simple, when you will get some positive cash flows, that means operating gain, I should say, you need to pay some tax charge on that. Revenue minus cost, there will be some profit, you will have to pay tax on it. That's a clear-cut cash outflow. Usually, whenever it relates to any particular year, it will be paid in that year only, or the question will specify when are you going to pay the tax. So pay accordingly. But there is another impact also. Impact of tax on depreciation. You will say depreciation is a non-cash item. Why do we need to see the tax impact on depreciation? Because the tax impact is not non-cash. It is a cash item. It brings you tax savings. That is termed as tax allowable depreciation. Impact of tax allowable depreciation. So here we are typically going to use UK taxation rules to understand the tax allowable depreciation, which is also known as capital allowances or written down allowances. These are the terminologies which can be used for depreciation. Now what do we have here? Number one, you have to use UK taxation rules for TAD calculation, tax allowable depreciation. Number two, it is given every year of ownership except for the year of disposal. That means the terminal year. We term it as terminal year, when the business is going to end. In the year of sale, you are selling off the business, or you are selling off a whole lot of assets on which you were claiming capital allowances, depreciation. Then what is the treatment here? A balancing allowance or balancing charge will arise. Now what is this? So you have original cost of asset, reduce all the depreciation which you have taken till date, all the TAD, tax allowable depreciation. Now this will be the written down value of the asset. Reduce the disposal, yes, sale proceeds of the asset, disposal value of the asset, reduce it. If it is a positive balance, that means it is the balancing allowance. What is balancing allowance? There was a value of the asset, but it got sold in a lesser value. That means the sale proceeds are lesser than the written down value of the asset. Case of loss, you need to claim that loss. Claim it as balancing allowance. But if it comes out to be a gain, that means written down value of the asset was $100 and you sold it at $120. So $20 is a gain. You need to pay tax on that gain. That is a balancing charge. Now it will be charged. It is an item which will be an income for the income tax department, right? Which is HMRC in terms of UK tax. So you have to give the impact of tax allowable depreciation and relief on tax allowable depreciation, tax relief. This we need to do. Now, how do we do that? So this is the theory discussion. Let's just see how to apply it. And we come to, again, practice a question. So this is illustration on taxation, which is a part of investment appraisal, where we will see the impact of taxation, how we deal with tax in such questions. A company buys an asset for $26,000. It will be used on a project for 3 years, after which it will be disposed of on the final day of year 3 for $12,500. That means here an asset is being bought. It will be sold after 3 years when the project will get over, and it is going to be sold at $12,500. Tax is payable at 30%. Tax allowable depreciation is available at 25%, reducing balance. That means WDV has to be used for this. And a balancing allowance or charge should be calculated when the asset is sold. So remember one thing, even if this sentence is missing, you need to calculate a balancing allowance or charge. Net trading income from the project is $16,000 per year and the cost of capital is 8%. Required, forecast the free cash flows of the project and determine whether it is worthwhile using the NPV method. So the first thing which you need to calculate here is the depreciation. Why? Because we need to give the tax relief on this amount of depreciation, tax benefit. For that, let's just first calculate the amount of depreciation. So let me take as year 0, then year 1, year 2, and year 3. Year 3, your project will be over. You can use time also rather than 3. So year 0 or time 0 is right now. I mean, this is for your understanding. Don't write this in the exam. This year 1 is after 12 months, right? That means 1 year has passed. That is year 1. So at year 0, you are going to make initial investment. How much are you going to invest? 26,000. So investment is 26,000. Now, what will happen is you will get a depreciation, claim for depreciation. So tax allowable depreciation is coming at 25%. So year 1, you will claim depreciation. Let me just do one thing. Let me write it this way. We will use this format into for making the main NPV calculation, we will use this format. Okay, here let's do it in this form. So investment 26,000, year 1 tax allowable depreciation, we'll take it in minus 26,000 into 25%. 6,500 depreciation you will claim. Next year also you will claim depreciation. The WDV of the asset will be 19,500. Then year 2 tax allowable depreciation would be 25% on this amount, but again we need to take it in negative. Right? Now what's the WDV? That comes to 14,625. Now this is year 3. Year 3 is the final year of operation for the project. You do not claim depreciation at that year. So last year May, you will just have to see the sale proceeds. So how much are the sale proceeds? Disposal proceeds are going to be 12,500. Now check for if it is a gain or a loss. So it seems to be a case of loss here. An asset having a WDV of 14,625 is sold for 12,500. That means you have incurred a loss of 2,125. This loss will be claimed in the name of balancing allowance. You need further allowance, further deduction from the income of the taxpayer. So this is the balance allowance, balancing allowance. Now where do we use them? We will directly have to give the benefit or the effect of these depreciations and tax on these depreciations. This is how we need to consider their impact. Now let's just first go back to this calculation. So year after 12 months only, you will be earning something. So the net trading income will come to you after 24 months. That means year 1. So income you will earn at this point, not at year 0. You will earn 16,000 here. Then again 16,000 here, because this is 16,000 per year. Is there any expense? No. Now what do we do? Now let's just deduct the depreciation from this amount. Why? Because tax will be paid on an amount net of depreciation. Tax will be paid on an amount net of depreciation. And then once we calculate that, we will add back the depreciation. There is another approach of doing this. You can directly take the amount of tax on this depreciation. That means, what is the depreciation in the first year? That is 6,500. So 6,500 into 30%, that you can take as a tax relief. That you can do and directly add back to the income of every year. Why? Because by claiming this depreciation, you reduced your income. Because you reduced your income, you saved some amount of tax. That is why this depreciation attracts tax relief. So I will suggest directly take tax relief rather than doing this approach by first deducting depreciation, then calculating tax, and then adding back the depreciation. I will recommend take directly the tax relief. So tax relief, okay, let it be like this because many of you would have used this approach in calculating. Okay, let it be depreciation first. So we deduct this depreciation like this, then like this, and 2125. Be very careful here, right? So these are the three amounts which are used for calculating depreciation. Now you must have got this amount as net income and you would have paid tax on this. Again, tax is an expense, take it in minus. Right? So this is the amount of tax which you have got. Now this is the profit after tax, but we need cash flows. And for cash flows, we need to add back the depreciation. The TAD we need to add back. How do we add back? We need to consider this 6,500 as addition, right? All these depreciations which we had deducted, we need to add them back. So I can use minus of this minus also, it will be automatically added. Then minus of this, it will be automatically added, right? Now these come to be the cash flows. Add them back. Right? Add them. Now these are the cash flows. But now we have one more thing. What? We have initial investment. What is that initial investment? To start the project, an initial investment was to be made. For what? For buying the asset. What was that initial investment? That was 26,000. Right? And this asset would be sold at the end of the life of the project. That means scrap or sale proceeds at the end. These sale proceeds are going to be positive 12,500. This is the amount which you will receive by selling this asset at the end of the project. Now the net of these will be free cash flows. Net free cash flows. Right? Now what do we have to do? To calculate net present value, we need a discounting rate. What is the discounting rate we have to use? Now there is no chaos of inflation in this question. So we directly use the cost of capital for discounting. So present value factor at 8%. So again, using the calculator, 1 divided by 1 plus rate. 1 divided by 1.08. I get the first factor. 1 divided by 1.08. My first factor, year 0, it will be 1. First factor comes at 0.926. Then 0.857. And 0.794. This is what I get as the present value factors. Now we just have to calculate the present value. Not the net present value. I'm calculating the present value. And now we can just calculate the net present value. What say? Is it coming to be positive? Yes. So should we accept this project? Yes, right? Because the net present value of the project is coming to be positive, it is worthwhile to accept it. And you need to just end this answer with 16,353 of net present value as the concluding comment, right?